What's your method for learning? How are you thinking about this? How are you going to show that you are not a know-it-all, but a learn-it-all? Because that's what's going to happen in the market. And to me, I would say for me, a non-negotiable is they already know it all. And they haven't actually learned it because you don't really learn it until you're out there in the market
Mm-hmm.
banging your head against the wall. But if they can't reconcile that, I probably am not a good partner with them.
Hi, everyone. Welcome to our show. We have a special treat today. Carey joined us. Carey, thanks for joining. It's great to have you
Thanks for
here.
having me.
So, just to kick things off a little bit, I want to introduce the audience all the things that you're involved. Hopefully, that will help them understand why we're so excited to have you here. Carey, you run um, a studio, incubation studio, in Southern California, which is on its own, I think, great trait to be on this call to help first-time founders because you work with them closely. On
Mm-hmm.
top of it, you have your own startup with your partner, so you also are hands-on. You know the ups and downs and how the startup world works, and that's not enough. You also run a VC where you have LPs, banks, and you invest in startups. This is like like a gold mine for us, for sure. Thanks for coming here. Thanks for being here.
Absolutely. My pleasure, and happy to chat about anything, as you know.
I know, I know. It's thank God we scheduled this for 5 hours. Uh, Gary, just tell us tell us a little bit about yourself because I also know um, you as an executive at one of the credit agencies as one of the product leaders. So you've you've come from a great background, and like so knowing your story from your mouth, like how you came to be here, I think it would be a great start.
Sure. I mean, for me, and I think on a lot of my bios, it's sort of the last thing says, really all of what I learned working in a family business growing up. And I had the great fortune of being born into a multi-generational family business. I got to start working when I was really young, partly because I was curious and probably a little bit precocious, and my dad wanted to give me something to do.
Hmm.
And I got to work alongside him and my grandfather as a kid and really did learn most of what I feel like I needed to help me in the world. And a lot of it had to do with interpersonal interactions with people, understanding customers' problems, taking the time to listen and try and be a useful solution to the problems that they had. And I saw my dad do that, or things like not ever asking someone to do something you wouldn't be willing to do yourself. I remember walking around the store and see my dad just bend over and pick something up, and he could have easily said, Carrie, pick that up, right? And just like modeling those kinds of
Hmm.
behaviors have been really meaningful to where I started. The one thing though, I just determined that I couldn't do for my career what my dad had done for his or my grandfather had done for his. And I was probably going to try to change the business if I stayed in it, and loved my family too much to put those relationships at risk, and didn't love the business so much that that had to be my life. And so I said, I think it's better if I go off and pursue some other potential adventures or opportunities. And I had gotten the technology bug pretty early in my life and had tinkered around with programming in BASIC and playing on my Apple IIe as a kid, and I really started to decide I think I need to go lean into that a little more. So let me go see what that entails. And so I ended up getting into a software company pretty early in my career and was really captivated by the power of what that could do. And that really led me to a whole series of adventures, mostly earlier and earlier stage startups, to then actually starting a few and being involved in a bunch of really early stage ones. And the last thing I'll say, and we can go into any of that you want. The last thing I'll say is I played a lot of sports. I'm very competitive. I love games and competing. I played individual and team sports. I loved team sports more. And I concluded years ago that I felt like startups at their best were a team sport, not an individual sport. And I love being part of and helping to build teams. And so that's been another hallmark of what I've really enjoyed over the
Cool.
course of my career.
Awesome. So let me tie that somewhere. Like I'll tell a short story. Bino, you don't know this one, but I was looking for my for my new venture some beta customers. I went to Carey, and Carey introduced me to his one of his investments, and I got to talk to this founder. A great guy. Like going through his startup things and raising money and making ends meet and all that and building a great technology. He goes, yeah, it's been like more than a year. Carrie invested in our company. I haven't I haven't met Carrie. He said, face to face. I should come visit you guys in Southern California. I said, what? Like, how is that possible, Carrie? How can you invest in a company without even like a handshake with a founder? So here's the question: like when you're investing in a company, or like when you think there's something here, do you tie back to your originals, like that how you got the business lessons from the family business? Like, is it about maybe like what characteristics you look at the founder to be able to invest your money without even a handshake or seeing him in person? What gives you that confidence and the optimism?
Yeah, I think I mean it somewhat depends, right? If it's a really early stage company, I have gotten much more comfortable, particularly in the last 5 years with COVID. I've gotten much more comfortable in the last 5 years in my belief and confidence to build a relationship this way, virtually, like this.
Hmm.
And that the things to lean into, the conversations to have, I think can still be done this way. It may take a little bit different form, may take a little bit more time, but I think it's possible. And I definitely believe that more now than I did 5 years ago. So that's part of it. And I think the other is really early stage investing. I didn't say this, but I sort of believe this, that, like angel investing, as it's often called. I mean, angel is a word, right? And like the idea of an angel is somebody who is taking a leap of faith in this founder, in this opportunity, and it's probably right on this knife's edge of charity, benevolence, and investment, right? And so, like, I've heard people call it for profit philanthropy, and it's not, if you really are being objective about it, it's not that far off because, I mean, walking in, if I'm not going to do anything and I'm just going to throw money and darts at startups, I should assume somewhere north of a 90% failure rate. And so if you're walking in, you're like, yeah, it's basically, you can call it charity, you can call it tuition, whatever you want, but you just hope that that 1 out of 10 pays for the other nine, right? I mean, what we're trying to do with Operate, as Kyle and I talk about it, is we just want to improve those odds a little bit. So if I can get it from 90% failure rate to 50% failure rate, that's a way better odds for that individual company and for a portfolio. And so that is in many cases where we're trying
Hmm.
to play, because if you're going to do this as many times as I have or we have, you're never going to bat 1,000. You're never going to get it right every single time. There's just
I have to ask you now. So, are you saying that to increase the 90% failure rate and improve it to 50, that post investment you do something to help them? Or are you trying to be better at assuaging that before you fork over any dollar, any check size?
I'd say it's a little bit of both for sure. Like my methodology, I've summarized it on that really early stage as founders that we can love, working on problems we can get excited about, where we feel like we have some ability to do something to help that probability. And so that could be experience in the industry, it could be customers that we may be able to help them access more easily, it could be talent that we may be able to bring around them, co-investors, any number of those variables that we as people who've been doing this for a long time may be able to anticipate better than the founder may be able to.
Got
On the
it.
front end, that founders we can love working on problems that we can get excited about, I think some of that is absolutely a de-risking endeavor, in that like love is a broad word,
Mhm.
but some of that lovability is how do our interactions go. That doesn't mean they need to be agreeable to everything, every suggestion I make. I mean, I love people that want to go toe to toe and debate and discuss things and maybe are highly disagreeable, but they're incredibly passionate and informed on what they're trying to do, and they want to defend their position because of their experience, knowledge, etc. But they're not closed-minded to the fact that they may not always be right, and they're
Yeah.
okay with that if they can. And so those to me are the kind of lovable traits that lead to collaboration and coachability, and maybe their ability to attract others to want to work with them. So those to me are the kinds of things that we're constantly looking at when we're really assessing that, I'll call it lovability, because if they're really difficult in every dimension of who they are, that probably is going to present itself with customers and with
Mhm.
collaborators and people that they're trying to bring on their team. That could make things particularly difficult and increase their risks.
Got it. I have to ask because it's so important for anyone who's listening to hear from you as an investor, but an operator, and with all this experience. What are the non-negotiables that individuals' capabilities, personality, work ethic, whatever, they're off the table. As soon as they exhibit that, they're off. Not going to be part of our portfolio. What is that?
I mean, what one that yeah, I mean, the person that can't take critical feedback or be shown that they may not have it right. That's I mean, to me, it's just weird. It's probably a weird non-negotiable. I mean, it's easy to say the person who lies to you or something like that. Like, yeah, if they blatantly lie to my face and are unapologetic about it, yeah, for sure. Like, I don't need that. Or a jerk. Like at this point in my life, I don't need to work with somebody who just is unpleasant in every which way. I struggle with people who need to be the smartest person in the room, no matter what. They haven't written a line of code, and yet they have the best product ever conceived for this problem. And so part of what I will go into these early conversations and I'll say, look, I don't need to see a deck. Like that's a crutch. That's you on your best day pretending like you have it all figured out and you don't. And that's fine. Like I don't expect you to have it all figured out. You're just beginning. What I want to really dig into is how are you going to go about figuring this all out? What's your method for learning? How are you thinking about this? How are you going to show that you are not a know-it-all, but a learn-it-all? Because that's what's going to happen in the market. And to me, I would say for me, a non-negotiable is they already know it all. And they haven't actually learned it because you don't really learn it until you're out there in the market
Mm-hmm.
banging your head against the wall. But if they can't reconcile that, I probably am not a good partner with them.
Makes sense. It's absolutely what in my vernacular I know is I call it the don't work with turds
Yeah,
mentality. So
sure.
oh,
Yeah, that's a great way to summarize it.
the core value has worked because you can always sniff them out. I mean, if you can avoid that, especially at that age and stage, man, life is so much simpler. No
That's right.
amount of money or greed or opportunity can supplant that.
That's
I,
right. Yeah, and weirdly, Benoy, I mean, obviously I love it when we have a success and we make many times our investment, but I weirdly like I'm not doing this for the money. I mean, there's so many other ways. I mean, I grew up in a family business. I could have gone in there and worked in that for my career. There's a lot of different ways to live a life and have a
Mhm.
career and make money. And I do it for the like the total adventure and the stimulation and being able to be part of these emergent ideas and better solutions to move our world forward in interesting, better ways. That's what gets me really excited to do it. And if there is a financial reward that comes from that, great. It just allows me to keep doing more of those.
Mhm.
like that a lot. He's a good man.
Yeah, that's
Good
why
man.
he's here.
I know. I like this guy. Yes. And um, I've got so many questions for
Go
Carey.
for it. Me too. Like I'm trying to pick one. Go for it.
Post investment,
Mm-hmm.
uh, how how have you seen those who pivot and learn succeed? What have you seen? Because everyone's watching, listening right now. They want to know, what how can I succeed if ever I run into a Carey Ransom?
Yeah, the I think it is this speed and synthesis process that I see some have really radical, rapid iteration on, and others that are these slower turns. And I haven't come up with a formula that I think is like consistently repeatable. Uh, I've adopted this studio idea because I think this is a creative exercise. So you think about the great artists in history, some of them could crank out a world-class piece of art in a rapid period of time and others took years.
Hmm.
And so I would say I probably it's more about understanding the individual person's learning process and then helping them craft a strategy to best utilize their process for learning. Like I know my learning process is a high signal, high synthesis. I want to talk to a whole bunch of people and then try to find that synthesis. Others may be able to do it in a much more abstract or focused way. I don't know. I think it's really trying to help them determine that and then put a plan alongside of it that gives them the best chance. Because I don't
Mhm.
think you can force somebody to be a high iteration person if that's just not who they are as an individual. And I don't know that um, that is the best predictor of success or failure. I would say in general, if you think about like the software development eras, a waterfall software development process probably doesn't work great in today's world because pace of change is just too
Mhm.
high to believe that you can go away for a year, build something, not take any input in, release it, and it's going to be the right solution because a lot has probably happened in that
Mhm.
time that you were, in your building place, whatever that may be. And so figuring out how to have that right cadence of interface with the market, um, that to me, I think is the right types of things to really think about. Do you and there's do you talk to one customer potentially, or do you talk to five, or do you talk to 100? They're probably different levels of marginal value that or risk that you have to manage through that.
I think I believe in that a lot as well. If there is a improvement in your one cycle, 1% or 2% doesn't matter. If you can just keep doing that and faster, you will outpace everybody else, right? Like the
That's right.
people are just staying
Yeah,
steady. Yeah.
I definitely have a bias there. I would agree.
But it also, like, if you think about, I always try to think about what the Silicon Valley um, way of business, and then like what they try to do like I feel like sometimes the brainwashing for entrepreneurs, that they need to be careful, like in in the valley. I feel like they're always trying to build a unicorn,
Hmm.
and if you're not growing like 10, 30, 50, 100%, and you're not going to be able to achieve that, you better leave that, dump it, start another one, because there's an opportunity is being missed, right? And I've heard this many times. Like, I think the founder of Uber, it was his 13th startup because the first ones didn't grow as fast.
Mm.
And the challenge is like you just dump and then start a new one. But there are so many great businesses that can generate cash, that can generate the money back to the investors, dividends, and be more profitable. Maybe grew 5%, but it's still a great business. You don't have to dump
That's
it.
right.
It
Yep.
depends on like what you choose as a founder and with your investors, right? This is my
That's right.
goal, and then that's what I'm going to accomplish. Some it depends on what you decided for the business.
That's right. Well, I was reminded recently that more than 90% of the fastest growing companies out there, if you think of the Inc. 500, 5,000, are not institutionally financed startups, right?
Hmm.
These are bootstrapped or maybe friends and family funded or creatively financed businesses. And so, to your point, Ike, there are hundreds of different ways to start and build a business. VC has always had this great PR because when they do have successes, their outcomes are profound, but it is such a small percentage of the entrepreneur
Yeah.
market, and it should be. Even like in the bank tech fund that I run, we look at those companies much more about what I call proper capitalization at the when we're meeting them at those early stages. We don't look at them, and I don't think of us as a VC. I think of us as a strategic investor for an industry
Hmm.
that is in need of innovation and improvements to a lot of their infrastructure and business processes, and entrepreneurs can help them. And sometimes these smaller banks may be the entirety of the customer set that they're trying to serve, and it's not going to be a unicorn business, or at least on the surface, it's not. And that's fine. You just need to capitalize it properly for that opportunity. And one of the other things I'll say there is at times they may start with that, hey, this is just going to be a good growing business that's going to be durable and profitable. Awesome. And maybe along that journey, you discover a much higher growth, higher value opportunity. But that's fine too. Don't start with this binary outcome of we're either a unicorn or bust. So you
Yeah,
can
yeah,
also start with the idea of, hey, I'm going to go build a real and good business. And on that journey, I might turn over a rock that does offer me this explosive growth opportunity. And then I have to think about, do I want to pursue that within this business? Do I want to pursue it as a separate business? Where do I take it from
yeah.
here?
So just to follow up on that one, this is fascinating because if we're talking, if we put ourselves in the shoes of the founder, there's like micro pivots that you do all the time based on the
Mm-hmm.
customer feedback, and maybe there's a challenging and a new the competitor just comes up with $100 million seed investor, and then you have, but there are sometimes macro pivots, like you really need to change the direction of the company
Mm-hmm.
completely. Have you run into those? Like, what kind of advice do you give to investors, founders, the people that are associated, like even the employees? It's not a
Sure.
easy thing to swallow.
Oh yeah, it can be. I mean, that can be one of the most difficult things to reconcile and do is to say, okay, this business that we built, maybe it's hit its useful life or size limit or whatever it may be, and there may be something else that is either uncovered or needs to change. I've been in the middle of several very significant pivots
Hmm.
through my startup journeys, and there have been times where, I mean, I ran a company where I had to completely reboot the entire team because it was clear the existing business was not, it did not have any growth. It had some stickiness that allowed us to harvest cash flow to invest into a new opportunity that had high growth potential. And so, but I needed a completely different team to do that. And
Mhm.
so I had to make some very difficult personnel and strategy decisions. How are we going to allocate resource, and how are we going to go about executing on this opportunity? It ultimately led to me turning it into two businesses under the same roof and then exiting it by selling it off in two pieces.
Wow.
So that's one reality. I've seen people spin a company. I was talking to a friend of mine the other day about taking a piece of their internally developed capability and spinning it out into its own company. I'm seeing some banks that are contemplating doing that, where they develop something internally to solve a problem only to realize that a bunch of their peers also need help solving that problem. That could be its own standalone product or even company. And so I think there are a lot of ways to potentially move that forward, whether it's, do you change the business internally? Do you actually change the structure of what this actually is? And maybe it needs to be multiple legal entities that do different things. And you see it at scale sometimes in some of the bigger companies that break apart. And you've seen it even in history where maybe a piece of functionality actually becomes the thing that is the company, whether it's, somebody like Twitter as an example, and how it became what it did, where it was part of something else. So I I just feel like having people around you that can maybe more objectively help you evaluate that is usually a useful group to have, friends,
Is there like
advisors,
a
etc.
board or investors or
It could
peers,
be,
peer networks?
I think it depends on the person. I don't think there's a prescription that says this is how to do it. I think some entrepreneurs can zoom out and do it themselves fairly objectively. It's about that self-awareness is such an important trait for all of us.
Yeah.
And to the extent we don't have it, having people around us that can help us see those things is huge. In my case, my wife is a huge person at helping me see my blind spots. She reminds me often of my misgivings and blind spots, and I appreciate her for that.
Yeah.
Yes, we know that feeling. We know that feeling.
Like
So
Benoy, just a quick note before you ask your question. I remember you giving me an advice on my business about this, and then your advice to me was, this is years ago. I don't know if you remember. Said, Ike, when you come to the company every day, uh, think as if you've been just appointed as a CEO of this company today.
Mm-hmm.
What would you do differently? That freed me so many times, like from the things that we've been doing it this way. It's just part of the company, and we have to stick to it. And
Mm-hmm.
that was a great suggestion.
Every day is day one, right?
Yeah.
That's yeah,
it is. It's necessary. For we all get sucked into the emotion of committed activities, whether
that's right.
they're good or not for the company. But we have our emotions dragging us instead of
Yes.
the cold, cool analytics of knowing what the business needs. And that
Mm-hmm.
happens a lot. And that's where I wanted to ask you, especially as an investor, but you've also started your own businesses. What happens? What have you seen in the leadership styles of those who are successful? For no one can start a company or grow a company by themselves. And after the investment, what have you seen in the way that they lead their teams? That you see, yeah, that generally bodes well for my investment. It means that I have a higher likelihood of the money coming back. What have you seen, Kerry?
Yeah, it's a great question, and I think we always are looking for that. I think a lot of investors think about pattern recognition and how do I find that pattern that has worked before. I challenge it a little bit. I mean, I think as an example, there has been a pattern in Silicon Valley of this somewhat socially awkward, introverted, maybe even sociopathic type of founder who's been very successful from an investor standpoint in willing a company into existence and almost carrying the whole thing on their back. And they've left a lot of carnage in their wake, and it hasn't maybe been the healthiest, if I mean even unhealthy and poisonous. But from an investment standpoint, has made a lot of people a lot of money. It's a pattern, and I've seen people uh, get behind those folks and do it again and again. Um, I tend to feel like that's not the kind of environment I want to be around or be a part of, and so I tend to probably prefer a little bit more self-aware, empowering, lower ego type of founder who wants to create an environment in which they can just be a magnet for talent and unlock the value through that combination of people, and being much more meritocratic about it and saying the ideas and the best answers can come from anywhere. Let's get a really strong group together aligned around a mission, and let's go walk through fire together. And I may have to lead from the front as the founder, but I'm quite okay if others start to rise to the occasion and lead other parts, if not the most important parts of this. And that idea of I'm not here to be the CEO because my ego says I'm the CEO. I'm here to help lead this mission to some impossible, seemingly impossible ending for this first season. And my role may change as the mission changes, and accomplishing the mission successfully is the most important thing, not what my role is in that. I think that those are the types of leaders that I probably tend to have a little bit more of an attraction to.
I concur. You know that I coach first time tech CEOs along their journey, and invariably, apart from passing the no turd core
Mm-hmm.
value, the biggest thing that I've seen over time is this ability to lift others ahead of themselves.
Hmm.
And you can see that in the demeanor. It's almost like a sleeper, right? I'd rather get a car that doesn't look like it's fast, but has a big old V12 engine under the hood.
Hmm.
And once you find out what kind of caliber that person is, that carries more weight for me than their almost celebrity status in having been
Sure.
in the forefront. And it's a little too. We've seen enough of that from WeWork and all the other companies that have had mercurial personalities.
Hmm.
I'd rather go, come on, let's just be smart, inclusive, hardworking, and create things with a collection of people, not solo. And I'm sharing this out in front of everybody because I think in the long run, you win by doing good things with other
Hmm.
people and not standing out on your own, right? And I've got too many examples that I've seen. I too have been the bad guy in some instances, and I realized,
Sure.
oh no, my head got too big,
Sure.
and I realized, okay, I now know my limits as well, and how can I surround myself with others who can keep me grounded. So
That's right.
the lessons
Well,
we learned.
yeah, and I mean, it's a tough, it's that early stage, especially like that CEO title. I laugh in many cases because I go, it doesn't matter. Like, you don't have a product, you don't have a company, you don't have a customer. You can call yourself what you can call yourself CEO, but you're not doing the CEO job. You're in the survival stage, and you probably have to be the chief revenue officer and the chief product officer and the chief customer. Like, you got to be everything. So you can call it whatever you want. I've tended to be much less title oriented in my career, and even with the folks that tend to work with me, they at times are looking for a title change or something, and we'll get into a whole philosophical discussion. It's like, okay, why do you need this? Is this for you and you need this validation, or is there a better game we can play? Like, this may get you in the door with a customer easier. Well, if that's the case, sure, take it. If that's going to move the mission forward, great. If this is about assuaging your insecurities or ego or something, then is this really necessary? Are we aligned in the best way as a team to accomplish the mission? And finding that right balance is part of managing and leading a team.
I have to tell you this one story, and then Ike, your turn for questions. People used to ask, "So what do you do?" And as I was starting a company or two, even when I had investors, I would often respond as I got older. I'd say, "Oh, I'm just a struggling small business owner." Right? That's really what it is. It's a struggling small business owner.
Mm-hmm. Yep.
Nothing else, no title, no nothing. And some of the people that I've shared this with, they liked it a lot. They laughed and they acknowledged it. That's what we are. It's just small,
That's right. Mm-hmm.
struggling owners. So all of that. Ike, your turn.
All good. So I'll I'll pivot to a little bit of the struggles of the CEOs these days. So, the for the past 2 years, I think times changed. The capital is not cheap anymore, so
Mm-hmm.
raising is hard, and that also resulted in, okay, you have to make your company last longer,
Mm-hmm.
right? And that means you're paying attention to all the things that will um, reduce your capital, the money you have, uh, lower and lower. Um, and one of the uncomfortable things about that for most CEOs is sales team, like underperforming sales team. Like, how do I hang on to,
Mm-hmm.
like, the coach them and let them try it? Maybe it's my product that they say my product sucks because my sales teams keep telling me it's the product. Product is the reason they can't sell. Maybe, or competition, or something else. So
Mm-hmm.
tell us a little bit about these dynamics these days. I would love to get your opinion on, like, what advice you give to the founders, how they should think about this, raising money, making the money last with some tactics. I know it's a loaded question, but Just like
Sure.
it's an open topic.
Yeah, and I'm the way that I invest probably is because it suits my personality. I'm still a bit more of a Midwest pragmatist when it comes to capitalizing and investing in companies. I use the terminology with a lot of my founders around have to raise money on this journey toward potentially want to raise money, that you really want to move from
Hmm.
that one phase to the other. And have to raise is about survival. I still have to prove out some key hypotheses or aspects of this business. Can I grow at a rate that the market has interest in? Do I have a value proposition that the market wants to pay me for? Can I build systems that can make other people successful doing this? Does it have repeatability, scalability, etc.? Those are the things in those early stages that you have to prove out, and that's where you have to raise money. That is a subsidy toward proving those out. And the way that I think about venture capital or private investment like that, it's a form of debt. And at some point, it has to be paid back. It has a little bit more flexible terms than if you went to the bank and borrowed money, but it also can be really expensive. And so, this idea that if you can take a little bit less, that's a little bit less debt that you eventually have to pay back in some way. And so, I think the interest between founders and investors is better aligned now than it was a couple of years ago. So, I actually think it's a healthier environment, and people are being a little bit more diligent and prudent about those dollars
Yeah.
in this environment. So I think that's good. And if you think about it toward this endeavor of, I'd like to eventually get to a place where I can control my own destiny, the business can kind of run on its own, and then we may discover a place where we want to raise more capital because we have the potential to grow faster, or we could go acquire another company that maybe isn't doing as well, or a piece of complementary capability that makes us actually collectively worth even more together. That's a very different place to be as a business versus continuing to be on this. I have to keep raising, I have to keep layering more and more debt effectively onto this business, because as we're seeing right now, a lot of those companies that got hooked on that during even the hype cycle are going to have a really hard time ever paying that back. And
Yeah.
they, as I call them, they're really what I would characterize as the walking dead, and that can take a lot of different forms. But if you're the founder and operator of a business that has a cap table of heavy weight on top of you, it's like any kind of debt. It weighs on you, and it ultimately could be the thing that ruins this opportunity for you.
Hmm. That makes sense.
It's
So
so
I'm big on, it's never going to be perfect alignment between founders and investors, but there's a healthy tension, and there can be much less healthy versions of that as well. So I think
Okay.
finding that sort of healthy tension is what I tend to try to look for.
It's interesting. Like the I really like the way you said like I have to raise versus want to raise. But Bino, you told me a story years ago. It was one of your companies. You figured out. I think you had a mathematical equation. If you borrow money and you can turn that what percentage to an ARR, and you were ahead, so that was a signal for you. Can you tell that story, like signal for you to go get more money to grow the business?
oh yeah.
It was a very simple equation.
Yeah, I wish those opportunities came more often, but way back in a software company, I knew that every dollar I put into the marketing machine, I could get $3 back, and it was proven.
It's
And
great.
right,
Yeah.
that's when you want to get extra money because
Do
then
that until you can't. That's
that's
right.
right, until it tapers off on the return. And that's the kind of predictability that people will start bashing on your door to give you money versus
That's
I
right.
have to meet payroll. and I've gone the other end where I had to survive, and you make and perform unnatural acts in order for that cash to come in, and then you're saddled with that burden throughout the entire time.
That's right.
So that's where that came from, and it is something that I think about a lot lately, especially as I think about the correction that needed to happen. And this is the right thing right now. It is hard to get money, but it's not supposed to be easy.
That's right.
You're supposed to have to get certain things in order to struggle through that, to sip from the straw before you can actually say, "Give me a whole tank of oxygen," because then you want to use it for growth.
That's right.
And
Yep.
the selling on a story is a rough and misplaced way to invest dollars, and that's
That's
my
right.
very strong bias. Right?
Yeah. Well, if you think about it, I mean, when you can input a dollar and get three back at very high certainty, that should be an easy place to get money.
Yeah.
And a lot of founders will say, "I already have that. It's already figured out." They don't have the evidence. They have it in their mind,
Yeah.
and the only thing standing between me and success is money. And the reality is, if that's actually true, then something's not, the evidence isn't there, or something like, because money will find those easy opportunities, or certain opportunities. The reality is that entrepreneurial journey is one, I call it, from complete uncertainty when you're starting on a quest toward complete certainty. And where you are on that journey is debatable, probably, between your ability to storytell and show evidence, and the investor, who has to be a little bit more skeptical because they need to see how truly certain or uncertain this is. And then they're going to price it accordingly.
We had a guest earlier on who has done 3, 4, 5 companies, and this last company he has grown organically up to just under 300 employees, and he said it's the best thing ever. The amount, you can see it, right? Because he went through that hard part, he went through the tunnel, through the briar bush, he went through
Mm-hmm.
all the pain, and he can say, yeah, look how thriving my business is under my control, with
Mm-hmm.
no equity being shared with anybody else. And I did it without any investment money. Ideally,
Amazing.
that's what everyone wants to be at. That's where
Sure.
they aspire to be, right?
Yeah.
And so, a quick question for you. I run into this a lot too. I'm advising 3 CEOs right now that I've said, you know what? I need to get some experts for you because you haven't figured out how the cap table works, particularly when you're talking about successive rounds and the dilutions that happen and the ultimate weight that you bear every time you take in another round.
Mm-hmm.
You have
Mm-hmm.
not got that experience. Would you agree with that? That people don't understand what that whole sequence needs to be before they even take the first dollar.
Yeah, I think it's very important to understand what the subsequent rounds or stages could look like, because you could get to a place on a whole bunch of levels. I mean, the amount of money total, the dilution, but even the potential misalignment between angel investors that were there to help you, and successive other types of investors that may have very different goals for the business. And as that gets more elongated, you have even things like structured funds and fund lives, and when they need to potentially give money back to their investors, and how that may push them to push an entrepreneur to do something that could be completely unnatural. And so there are a lot of varying characteristics, or challenges that might get introduced, that they may or may not have any awareness or experience
I
with.
think founders
And
need to
yeah,
educate themselves on that one. Go ahead, sir. Okay.
that's totally agree.
I found like there's a few people on LinkedIn that I follow. They share the data from Carta.
Hmm.
Uh, not that I'm recommending Carta, but the data they collect is awesome. One of the posts recently talked about how dangerous it is to do safe notes on top
Mm.
of each other, The safe is the fastest way to get money sometimes. So the
Hmm.
founders are like, okay, great, I just got the money and I'm in survival mode. This is what I needed. But they don't realize how those stacking up safe nodes reduces their dilution to a level that when they exit, they're not going to have anything.
It's possible. Yeah, you better be keeping track of that as if it's all converted, right? You
Yeah.
maybe haven't. I mean, I've been in some safe scenarios where I'm an investor and maybe the business converts, and all of a sudden you get the cap table and you see that they had a whole bunch of different terms with different investors. And it was almost like they were negotiating individually with each one. And I've been on a scenario where I was like, whoa, I did a really good job of negotiating that one. And I've been in others where I go, whoa, they gave that to that person. That's crazy.
Yeah.
So it's, yeah,
Yeah.
I think for a bunch of reasons, they can be great, but they also can
Yeah.
create a problem if done in excess, like you're describing.
Yeah. Okay. Bino, I have one more question. Like,
Go.
you, Gary, you're in a unique position, I think, for this one. I'd love to get your take on it. You're connected to the banks, as they're your LPs, and you're trying to find them new innovative companies to do. And then you're obviously involved with the startups who are raising money. They're not building their own without any investors. They're doing it with the investors. So I heard this thing. I don't know how true it is. This is what I want to get to. Like a few years ago, I've been told the LPs had so much money in the VC bucket, but they didn't have enough in the open markets, like stock
Sure.
market.
Yep.
So they wanted to correct that. Now they're
Hmm.
getting enough returns from the stock market. The stock market is doing well, and then they didn't need to go back to the VCs to give money. Is that true statement, these dynamics, and then do you think it's gonna change in the next 2 years, 3 years? Like any insight information, because you're like you're one hand is on this side, the other hand is on that side.
Sure. I don't see that super closely with banks because banks aren't typically investing across that entire spectrum. Like the banks that are
Mm.
investing in our fund are doing so really for the R&D innovation and strategic value of it. And the fund was just a way for us to codify and structure
Gotcha.
that. But with that said, I do study institutional investment, and what happened with the interest rate changes and some market changes is they did get, and some of this was a long-term zero interest rate
Mhm.
environment issue. In any kind of interest rate environment, people are constantly looking at next best alternative investment opportunities. And when fixed income was effectively at zero, you saw institutional investors making different allocation decisions, and private equity, venture capital got overly allocated versus where it had been because the returns were warranting it. They were better than 0%.
Yeah.
And so what happens sort of season to season there is they get into rebalancing situations. It's often referred to as the denominator problem, where as the denominator changes, and if they've committed to allocate 15% of their total allocable assets to private equity, and all of a sudden that becomes 25%, then that's going to affect them with either for sure new commitments as new
Yeah.
opportunities, new funds are presented to them. Maybe they're in three funds for one venture fund, and now the fourth fund comes along and they say we don't have the funds to commit to it, even though they may want to. So and even in some cases, it could lead to an interim problem of funding commitments. They may say, we had committed because, as you know, I may have committed $10 million to a fund, but they call that money over time. And if I don't have the money to allocate because I haven't been able to take it from other buckets, I may not be able to fulfill my commitment. And that could be a really big problem. I don't feel like we've seen that as much as I actually anticipated that we might. But I did just recently hear from a fund that I'm an investor in that a couple of their limited partners have defaulted on their commitments and they're making those available to other investors. So there are, and sometimes investors have ways to liquefy positions to try to do this. But I would say we will definitely see some shrinkage in the commitments to private equity, partly because they got so overly allocated in this
Hmm.
prior season, and partly because the alternatives that have much more liquid markets to them, like the stock market or fixed income return types of assets, are relatively not as bad as they were because of the changes in interest rates. So it's, they look at these things somewhat differently. It's typically pure financial return is all they're
Yep.
looking for. And so they're looking for this blended risk return. Other places, angels aren't really looking at it from just a pure investment return. Strategic, like I'm doing with bank tech, is not purely a financial return driven model. We're trying to drive strategic value to our banks
Got you.
plus financial return as the secondary benefit of it if we do it right.
Benoy.
Fantastic. Yeah. If I may, we're getting close to the end of our time. I have on the spot, I'm going to ask you to consider, Carey, just two pieces of advice to first time founders who are listening to this podcast. As you think of all the different areas in which you have had experience, what two elements would you advise them on uh, through all that you've done and have experience in?
So the first one I think would be, it's more important for you to love the problem and love the customer that has the problem more than loving your product. People, they tend to love the solution and love their product, and I encourage people to be way more obsessed and passionate about the problem and the customer, and that generally I think gives them a better chance of succeeding by
Hmm.
by finding those people that have that problem, can articulate it, and are motivated to solve it, as opposed to feeling like you got to shove this solution into people whether they care about it or not. So that would be my first. The second, which sort of relates to that, is resist building until you almost feel like you have to do it. Meaning, the more time you spend with the customers and them talking to them about the problem, the potential of a solution, and getting them so committed and excited, that's probably the better point to start thinking about building versus going off, building it, and then showing up with it built. Because I find in many cases, particularly today, it's far easier to build than people realize. And they're so proud of what they've built, which is great, but it doesn't matter unless the people that they want to sell it to care to have that built for them and want to solve that problem. So I think that it's almost counter to how a lot of founders are wired. They want to go build, they want to love the solution, and I would challenge them to almost behave in complete opposition to that.
Man, that was probably, I wrote it down in my book. That was very, very deep. I truly understand that. Having now done many startups myself and now coaching, you're absolutely right. But it is not an easy way to go because they're not going to be propelled that way. They're going to be propelled
Mhm.
by their widget, by their idea,
That's right.
emotionally bought into that even before they tackle the actual need of the customer.
That's right.
So, wow, very good. Thank you. That was
Thank
fantastic.
you, Carey. You've been awesome. It was great to have you. Your wisdom is going to help a lot of, I think, first time entrepreneurs. So thank you.
My pleasure. Loved hanging out with you guys.
Yeah, thank
You're
you.
terrific. We'll have you back again. We really need these insights. There's so many more topics. Carey, thank you.
Sounds good.
Much appreciated.
Absolutely. See you guys soon.
Carey, just wait 1 second. Make sure the videos are uploaded. And let me say bye to everybody. Thanks everybody for watching and listening. Hope you can join us again. We're gonna continue to have great guests like Carey. Thank you.